This is Justin Pulitzer. This is my weekend review video. It's coming out on Monday, September 5th. Happy Labor Day, the end of summer. Anyhow, let's dive right into it. I want to start out with a little bit of macro talk because this week was so dominated by, or I should say the last couple of weeks have been so dominated by the Fed. And here's my take on it. You have a lot of rogue sort of ish Fed officials speaking, and they keep kind of pushing the case for the rate hike. I think that they see that as being sort of virtuous, and I keep hearing TV commentators saying that the Fed needs to hike rates to get their credibility back. And in fact, I think the true hurting of their credibility isn't so much because they're not hiking rates, it's because maybe they're not doing enough to stimulate growth. And I think that I agree with some comments actually made by Larry Summers. I went on and I discussed this in my Periscope that I never thought I'd agree with very much Larry Summers ever had to say. But he agrees that the Fed making hawkish comments in the face of slow economic growth is making them look foolish. And I think that's because the Fed is supposed to be this omnipotent body, and they're acting like they, a couple of drunken sailors who can't hit the dartboard. Anyway, inflation is below their 2% target. The job growth is very stagnant. I know June had some revisions lower, July had some revisions higher, and then this month, August, was a miss. But it's a little bit deeper than that. Everyone was, kind of hanging their hat on the fact that the jobs were kind of like okay. You're having not only was this month a miss, but you have now a reduction in the average hourly work week, which more than wipes out any type of good gains that we had the prior month. It almost completely erases them all. So companies are hiring, but they're hiring part-time. They're hiring in more service industry jobs. I've talked about the waiters, waitresses, and bartenders. Today marks the end of summer officially, so no more carnival ride operators to kind of ride in and save the day. And government hiring has sort of been the X factor, which is what made July's number good. June didn't have that, of course, and then August was lacking again. So you again saw the miss in the jobs number. So the virtuous circle is saying that the numbers are kind of good enough. It keeps things, in a pace, but it's really, these numbers are terrible. The Fed went on and talked in their last minutes about lack of business investment, and they talked about the lack of clarity from the fiscal side, and that in a moment of rare candor in the interview that everyone took as so hawkish with Stan Fisher saying, we'll see the new jobs numbers, and, we might be on pace to hike. He basically said the Fed is his words, not mine, and I have said this too, so I guess both of our words, that the Fed is the only game in town. So I don't see until there's pro-growth policy why the Fed would be, looking to hike. Any growth that we have seen, by the way, has been or pick up in these business investment has turned out to really just be a refresh cycle. Inventories wear down, they get brought back up. People, who've waited all year have to make some replacements. They do it, and then it kind of goes. It's sort of back to square one. We've had weak GDP. I'm going to talk about that in a minute. I kind of gave a teaser for this week's video, and I said that there would be kind of this aha moment for the doubters of the lower for longer thesis, and I think I'm going to try and stress that right now. And this is really sort of in my view, the aha moment. So the first half of the year has been lackluster. The Fed has given us growth projections that they've fallen short of. Maybe they've come in, let's just say, half. So they are now counting on a back half of the year to kind of double up to catch up, so to speak. Like they missed the first half of the year. It's been weak. So now they're relying on a second half of the year to kind of get them back up to just basically back to even. So it seems strange to me that the Fed would want to hike interest rates after a weak first half of the year when they're counting on a strong second half to make up for the first half weakness, overly compensate, in fact. So the Fed pouring the cold water on the economy and on the markets seems to me that it would be foolish. It would be very counterproductive to their goal, given the fact that they are coming from a place that's in the hole. they're not winning the game here, so to speak. They're losing, and it seems to me like they would be taking their star player out, which would be lower for longer interest rates, in the fourth quarter when they have a deficit, or let's just say in the third quarter, because we're halfway through the year, so third quarter, going into the second half of the game and counting on, a miracle, so to speak, to bring the game home. Just doesn't seem to me like it would be a prudent move. The Fed in there, by the way, in their last minutes, mentioned that the GDP risked for GDP, inflation, and foreign risk were all to the downside. We know that the ISMs and the PMIs came in weak. Philly Fed, Empire State, all those reads were not good. We know that orders, by the way, have been softening. So if the Fed is, like I said, counting on the second half of the year to double up to catch up, it seems unlikely that that is a reasonable analysis, because the orders for coming forward for future quarters have been weakening, meaning that the numbers are not going to get better. They're actually showing deterioration, and that they're going to get worse. So that would be really kind of crazy on the Fed's part. Inventory levels have been dropping, so that's again part of the refresh cycle, that they're counting on the inventories being brought back up. So yes, that these numbers should improve at a later point, but they're currently in a down part of the cycle. That will eventually tilt up, which is good. We know that will be good later, but it won't be good now. Let's see. I said at least a refresh. Employment slowing, I've talked about. That was also evident in the ISMs and the PMI, that the employment components have all been weakening, even in the service sector, which has kind of been what's holding things up. Price trends a big stagnant. They hung their hat on export orders being good. That was sort of like the bright spot of the report, but that won't last very much longer if the dollar keeps rallying. So the more the Fed talks kind of smack, the stronger the dollar becomes, and then that hurts the one kind of shining star in their report, which was the exports. Just because the dollar had weakened, now the dollar is strengthening. That is going to be very counterproductive for the Fed. Anyway, that's our vegetables for this broadcast. I got it done in 7.5 minutes here. So let's use that backdrop of now a more benign and dovish Fed. I know the media is working us up that there's going to be some type of a September rate hike. I don't believe there will be a September rate hike. There could be a media-inspired panic that there could be a rate hike, and that would, put the numbers back up. They've actually, since the Fed statement, September probabilities have been dropping. December is sort of vacillating and stagnating. I have said, by the way, I think December is still on the table, but I do not believe September is on the table. And if the numbers keep coming out like this, we might be talking QE soon, not rate hikes. If anything, I do believe my cure, by the way, and this will never happen, I think, in our lifetimes, that the Fed should take the 2% inflation target and double it up to 4% and really step on the gas to get some growth going, because there is no fiscal growth policies that are coming with this administration, at least. If anything, the policies have been punitive. We have the highest corporate tax rate in the world. We all know about the drag effect of Obamacare, and that's one of the reasons for the part-timing and offshoring. Companies don't want to pay the Obamacare tax, so that they're reducing their work week. And this isn't just speculation. These are facts in the numbers. You can see that the average hourly work week is decreasing, and it's staying just under that full-time number, so that people don't have to pay that penalty. Anyway, let's get into the 7 market keys now that we've kind of exhausted ourselves, I think, in Fed talk. I think we are in just kind of this kind of stagnant, benign VIX time. More people will be coming back to the beach now at the end of Labor Day, so maybe we get a bit of a pickup. But look at this. I mean, we've spent periods of time with some, brief little spike ups, but chopping sideways. What I would be looking for now that we're at the lower end of the range, but the stochastics are picking up. You can see when this has happened before, when volatility has turned, you've had the stochastics pick up, pull back to this green line, and then it picks up again. Again here, spikes up, pulls back to the green line, and then pulls up again. So now I think volatility is sort of low but on borrowed time. So when this pulls back now to the green line, that's when I think you can load up on either S&P puts, or if you want to play VIX calls or pure directional plays via short, you can kind of do it on the pullback to the green line now going forward. Range-wise, though, we know I've created this the VIX key, and we are now, firmly in purely directional play. I don't think that there's much of a chance of an uptick in volatility as long as we stay below the 100 MA. You can see that it was holding the 100 MA, then the 100 MA became resistance. We had the gap up over the 100 MA, and that led to more. So you really need to be over the 100 MA, and you can see it's been huge resistance here for there to be more in terms of the VIX. So I think you could kind of assume a benign VIX until the 100 MA is violated and closed over. The dollar. I've said for a while, this could be the fly in the ointment for the bulls. You had a big outside day here. It continued to rally up and then down. And even on Friday, it kind of closed near the highs. We are below the 50 MA, so that's kind of like, all right. And I've said that as long as we stay below this 25.23, and you can see this rally stopped to the tick at 25.23. If you look at this number here, the high, it was 25.23 to the tick. Until that's really violated, we're just kind of in chop range. If anything, I could make the case now for I could make the case for a bullish or a bearish dollar. But, we could be setting up for one of these. I don't know that we will be. But, I am seeing a little head and shoulders here. A little bit of head and shoulders, so it's possible. That said, we are above the downtrend line. We're still above this bar's high of day. We're above the 100 MA, and we are above the 10 MA and the 20. So this head and shoulders pattern doesn't have to play out, but it's very possible there is some type of a back off. Maybe that happens in September when the Fed really doesn't raise rates, or more bad economic data. So let's keep it real simple, stupid. All right, that's how I like to be really simple and not overthink things. Anything that stays above this 24.71, this bar's high of day, there is no short to be had. Below the low of Friday, and if you can take out this 100 MA and the 20 MA and the 10 MA, this confluence of numbers, then I think there's a short to retest these lows. If we get back up above this high of day, 24.87, I think you have to assume the very least the 200 MA gets tested and potentially the downtrend, which is up here in the 25s. I do think that at least initially will be sort of some resistance, because remember what I always talk about coming up from the bottom. This trend line has resisted now 1, 2, 3, maybe 4 times is the charm, but it seems to me that a breakout over the downtrend and this level would be harder given that we're kind of coming from the lower end of range. I think at the very least there would be a pause. So that's my thesis on the dollar. Above these high of days here, it's a long to a 200 and a downtrend test. Below Friday's low and below the 100 and the 10 and the 20, all of this confluence, that then would become a short for a move to retest the low or end of the range. The bonds. Possibly the most important and critical part of the policy here of the Fed is this. We're just chopping. There's an old reference high at 38.5. Anything below there becomes more vulnerable. Above kind of keeps the lower for longer thesis firmly intact. You could use this Friday these ranges here, like basically 38s have been key. If we can hold 38s, we can test lower in yields or higher prices in bonds. We are here, though, below the 50 MA, so we do have to be a little cautious. Below the 50 is caution mode. If we were to snap this range here really to the low, I think we could see the 35s and maybe even 33s, and potentially even the channel low at some point eventually. I don't think that would be really a straight shot. I think it would be more of this kind of grinding action. And that could be the kind of panic buildup into the September meeting, which we don't think, when I say we, meaning me, doesn't think that there will be a hike. And I think that that could set up for a 200 MA test and a buy for the bonds. Like if this were to kind of gradually, slowly roll over to here, even if it can't happen fast, it doesn't matter. I would like a downtrend or an up channel. The lower end of the channel test, that to me would set up for an amazing screaming long, because like I said, I think the Fed is sort of talking tough. I don't think they're really acting so tough. One thing, though, that could be a bit of the fly in the ointment for that thesis, though, is this change in the XLF. That's the financials. This has been sort of the false dawn play of this has been going on for a really long time, where they buy up the financials, everyone gets excited, and then they kind of fall off of a cliff when the Fed doesn't do anything. We are above this 2393 level. This was a gap and hold, basically, and it's just been grinding higher. As long as we are above 2393, there's really no short in the XLF, in my view. I think that this could still grind higher up to the 25s. This might just be some portfolio allocation. If you want to be really short term here, the 10-day MA is the must hold. Anything below there gets iffy. I like this Thursday bar range to play against. Anything above 24.64 remains a long. Anything below 24.27, which was sort of this look below and fail, that to me would gain some steam to the short side, potentially to retest that 23.93 and probably the 50 MA. I'm going to have to redraw this Fibonacci level, but we haven't peaked out, so I haven't done anything with that. So financials looking a little bit bullish. Bonds maybe looking a little bit vulnerable, but I think that this is all just because of speculation, some portfolio reallocations. HYG not showing any. This is the high yield. This is when we get nervous, when we start thinking recession. This, though, is giving the Fed a little bit of cover because the high yield is not showing stress. The Fed gets nervous when high yield shows stress. But this really, to me, is just ho-hum, chop zone. This was a bit of a look below and fail. So as long as this kind of keeps meandering higher, it shows, to me, an improving credit condition. When you start getting your 30, 40, 50, 60% crashes in the markets, it always shows in the credit first. You'd start seeing this type of action, not this type of action. Oil. The oil. This is what I think has been weighing a little bit on the ES as well, the indecision in oil. We're sort of at a crossroads. The oil here almost had a 50% pullback. It stopped just shy. I think as long as we're above 42.49, oil is quote-unquote okay. If we start breaking below the 42.49 and this new trend line that I've drawn in, then I think we are in a new sort of defined down channel. This came down from the high, rallied to a lower high to this sort of breakout level, 49.33. This stopped at 49.36 and now has pulled back. From here on in, we did close just above the 50. Short term, I like this day's range is a sort of a gauge. Below 44.06, it gets a little squishy. Above the high of the day, 46.53, I think things will be a little bit hunky-dory to the upside. Again, I think oil will be benign as long as we're above 42.49, so basically 42.5. Below there gets squishy to me. Above here remains strong to me. Longer term, I'm more bullish than bearish on crude, but it's sort of at a inflection point here. XLE is holding where it needs to hold so far. Held to 50 with a bit of a look below and fail. This is sort of a little bit of secure low type of action. a low bookended by 2 higher lows, although I would have liked this one to kind of be on the 50. As long as this holds the 100 MA, though, really, the 50 and the 100, it's okay. If we lose that, then I think we get a quick move down to retest these lows down near the 200 MA. That'll probably meander up higher. Preferably, it would be a backside of this downtrend, which coincides with the 200 MA. I think that would be okay, but not seeing that much here. It is below the 10, which is now arcing, and below the 20. So it's sort of in show me mode, but as long as we hold the 50 and the 100, I think it's kind of okay. Exxon not showing as much resilience. This had been down a lot. It's still in this earnings gap range. If you can get above the 89.01, I think we're back to the upside for a potential retest of this old up channel. Anything below this range low here, let's say this now swing low, this 86.09, you know I've talked about in past videos the importance of 86s. This is a bear flag. If this does fall down out of bed, I think at the very least we would get a 200 MA test. I don't know that it would stop there. I think we could see 83s and potentially 81s. It would be amazing, absolutely amazing, if this were to fall down, get the 61.8 test, the 81 test, and it coincide with the channel low. That would be a screaming opportunity to buy Exxon or to sell out of the money puts in strikes down in below into the high 70s, mid to high 70s. So we're gonna have to see how this plays out. But as long, and I'm not gonna mince words, as long as we're below 89.01, Exxon still remains vulnerable. As long as it holds 86s and sort of this 84.70, 200 MA, it's just kind of chop and but still vulnerable. Needs to get back up above 89.01. China. So China is looking a lot better. I've been saying this for a few weeks. This was a gap. It's looking a little stronger. We're above the range. We've been seeing some strength in BABA, which you guys know I've been more bullish on. I think we could meander up and kind of just fill in this wedge and get back up to 40, maybe 41. That's my thinking. This looks okay. If we start getting now back below the trend, which would be the 10-day and the 20-day, I love that confluence there, then I think we could get squishy to a 50 MA test and maybe a channel low test, like it was sort of showing strength, but it was maybe a little more misguided. I love dramatic day ranges, so anything above 37.67, 37.67, and look, 37.66 I have as a breakout area, so anything above 37.67 is still a long. If we were to get back below 36.67, which is about a buck lower here, then I think we're getting squishy to a 50 MA test and potentially a 100 MA test, which would probably coincide with the channel low. But FXI, in the meantime, looking okay. Zibaba. All right, so Alibaba, this was an amazing earnings report. I don't care what anyone really has there to say other than it was spectacular. Baba pulled back. I actually got stopped out on this day because we were a slight lower low, very minor bounce, and then it kind of started to collapse. We held this bar though, and now it's back to the upside. I got back long this day. I tweeted about it. Let me zoom in here. It would be nice. Wouldn't it be beautiful if we were in close? Yeah. So once we broke the downtrend line and the 10-day, I was back in the trade. I always like when things work out right away, which they did. However, we are into a little bit of channel resistance. We are above these highs, though, so anything, in my view, that's above the earnings bar, the 98.35, and this next day, which was like a bit of a look above and fail, this 98.86, I think can still go higher. I've done some measured move projections. 99.94 was the low end of it, 102.52. Sorry, let's not talk about that one yet. 110.49 was the high end of it, and then I did a geometric mean, which just factors in the lower, the worst case or scenarios a little bit more, and I came up with the 104.01. There's a 1.618 Fibonacci extension up at 103.21. So I think we're going to 103s, 104s. That's my guess. If this does fall back down out of bed here and we start losing, since I have good trade location, I'm going to try and stick with this. The way I played it was I bought in January the 100, 120 call spread, and I sold this time around. I didn't the last time. I sold November puts against it. If we were to start losing this area again, this trend, I might even reverse it short and turn those puts into a long put spread. I have to take a look at that, and I'll update if indeed I do wind up doing that. But as of now, the fact that we're closed over this range high and we had the pullback, I'm thinking the higher end in BABA, given the fact that they had a good quarter and there seems to be a lot of interest in the BABA. I'm thinking higher. BABA has had a tendency to kind of fall out of bed and not acted well in the past, but right now I think a lot of that it's spent. Let me just go back to BABA quickly. Gotta just love that BABA, right? I think we're over this. Like you can see, we had a lot of these we had a lot of consolidation. We're above, we kind of retested the gap fill, pulled back, and now we're back through it. So I don't think that this is going to be as strong resistance, and I think that it's kind of clear for takeoff, for more. So I'm thinking higher in BABA. That's just my thoughts as of now. IBB. All right, so I talked about this one. I think I was pretty clear, Clarence, that the move down was unlikely to break down because it had already come from the range high. As I said, the breakout here was unlikely to stick because it came up from the bottom and we got the pullback. You now kind of have a double top, this sort of dramatic reversal, and we're marking some time on the backside of the old kind of wedge. Okay. So what now? What do we do now? All right, so the 50 MA here has held now. We've had 3 days. Look at this. I don't want to say it's a secure low because I don't think it is, but I do know that the 200 MA now is resisted and the 50 has now supported. And you have a low bookended by 2 higher lows. So let's keep this real simple. Anything above these, like above the 200 MA, let's use Friday's range high, 282.80, is a play to the upside to probably the 10-day and likely the 289. Anything now below the low of day here would invalidate even the inklings of the secure low, so that would be below the 279.84, and I think we would then pull back to at least the 100 MA, which is this 275.40 to 271. So Friday's range we could use as a buy stop over the high or a sell stop or an initiation below the low, and anything below this range low, 278.90 to 279.46. So yeah, anything below these lows is a short. Gilead. Acting poor. I've not liked this stock for a while. It ran up. It is pulled back. We are now below these lows. It's just looking not so great. However, I do think that this could either be a look below and fail, like if we were to come back up through these days' highs above the 78.60-ish area, then I think we would have another run back up maybe to 81s. This would have been a look below and fail. However, if this does stay below 77.92, I did a 1.618 Fibonacci projection given this range to the downside, and the big 50% fib coincides near there. So I think 70.30 to 71.17 would be a good right or right out buy area or an area to sell puts into, particularly if this were to come down hard and fast. So it's either the look below scenario, and look below and fail, and we come back it's at a buy stop over 78.60, or we look for 70s and 71s for the area to buy. ALKS has been one that I've liked for a while. It's below the channel and below the 200. As long as we are below the 200, it to me is still a little vulnerable, but and these are very poor lows. So the 100 MA here, which is roughly what held, is the key. Anything below these lows, the 43s, I think we see 40s and 39s where where it would find some support for a buy. But as long as we're over these range high, the 45s, the play is still back up to the upside, at least maybe to the backside of this downtrend, which would be 47s, 48s. You can see this is where this support initially was, too. Moving right along. Bristol Myers. So I actually wound up getting into this trade. I had originally tweeted 55s, but it adjusted it to 54s. It was already a little too late because I had made... I had misread this, that 54, 16, I guess sometimes it's better to be lucky than good. 54s, I think, given the fact that this has come down from basically from an all-time high, and you're going to be kissing the canvas into range lows, somewhere between 54s and 51s, which you can see was where this is where this gap fill was, and this was where this low was, and we have a hammer on Friday's bar. So I think into here, it could even have been, this could have been it. So I'm thinking that Bristol Myers is a buy now on any further weakness into 54s and 51s. This is just getting to be a little too much, I think. A little too far, a little too fast, and I'm actually starting to like, for a bounce trade, BMY. Mylan, I was saying that I thought could be a buy down somewhere between 40 and 37s. I'm starting to, here's my theory. Longer term, I think Mylan is going to be quote-unquote okay, because I like the idea that they raised their prices. They kind of used, I keep forgetting this term. I'm pissed I didn't look into this, but there's a term in marketing where you have a high-priced item that you use to sell a mid-priced item. And I think they raised the price of the EpiPen from 100 to 600 so that they can now sell the generics, which insurance covers, at 300. However, Minnesota and some various other, I think, municipalities are now looking into possible billing code issues, and they might come back to them and look for back monies. That could get a little squeamish. That just broke on Friday, and I think that there might be still some selling yet to come. So I'm thinking now somewhere between 37s and 32.85, which is the big 61.8 of the range. I'd be looking to probably try it long somewhere in there. Let me look on the 5-year. Yeah, this is really kind of a big level, the 61.8. So I'm thinking somewhere between 37s and 32s is likely. I mean, look, it's a lot of points from here. I don't know that happens. This basically came from this kind of range high to the range low. I'll probably try it right out on 37s, particularly if it were to get a gap down here on Monday. That to me would be interesting for a right out trade, or play put ratios where like you buy the 37s and maybe sell the 32s or 35s and then sell 2 times the 32s. This chart looks awful. This is a big bear flag. This thing could really break. I can see them being the new whipping post. Banks are getting a bit of a holiday now that the Hillary Clintons and regulators have the drug stocks to focus on. So Mylan has taken over for Goldman Sachs and for JP Morgan for a little while at the whipping post, and that's probably why XLF has been rallying a little bit. Anything here below the 200 is clearly weak. But this area, I think, could be a good right out play, at least for a intraday bounce play. So that's the Mylan. The S&P. Let's get into SPY. This is only supposed to have a $1.61 move this week, and we are getting a little cray as far as the distance goes here. I want to just show you one thing. We could spend a lot of time consolidating in a fairly narrow range. These tend to have larger liquidation breaks, so that's what I'm kind of on the lookout for, given the fact that we're in one of these. But I will say this. We had a look below and fail here. We had a look below and fail here. We kind of had I don't even know what to call this here, but again here, a bit of a look below and fail, and now back up to the upside. So the bears have really had a lot of opportunities to kind of sell the market, and we held the 61A to the range. So Friday we had a bit of a gap up, and it was a bit of it held, but it was a bit of a stalemate. It kind of filled the gap. So there really wasn't all that much to talk about. The market has spent a lot of time consolidating, and you can see the 20 MA is caught up quite dramatically. We're right at the 20 MA, and the 50 is really not that far below. So I see the downside risk maybe initially to the 50 or maybe the range low. Like if this were to fall out of bed, 210 to 11, which is really getting close to now the channel low, would be, in my view, an amazing setup for a right or right out buy for the end of the year, given the fact that this would be a big gap fill. It's a big fib level, the 50% fib, and we know 210 to 11 was really trouble. It was hard to sustain over there, and only until you gapped and went over there was it sustainable. So I think there's a lot of price memory here. Remember, this was Brexit. We stalled here. The high of day was 110.87. It fell apart there. Once we got over that, that's when we were off to the races. So this, in my view, is the true support, 210 to 11. So if this were to like lose this range here, this low, and we lost the 50, and then we lost the 214, this could really cascade. That being said, 212.52 was a reference area. The old reference high from in the Wayback Machine from before was 213.78. So it seems like the move to the downside is going to be stubborn and begrudging and hard. Like there's a lot of reference areas in there. On the other side, there's still so much people in here who don't believe the rally. You've had like two look above and fails here in the 216, 219 area. So I think if you clear 219s, at the very least, you'd see the 1.618 of the Brexit range, which is the 212.52 all the way down to the 198.65. I think we would see that. And if this started to really get blow-off-ish, I think we could see the channel high. I want to show you something on a longer-term chart. Most guys and gals don't think like this, but I do. We had from the 2011 low, we had a channel. We've broken out of that channel, and the backside of the old channel and the bigger term 1.618 fib extension is up at 230.59. Like if this were just to chop sideways or to grind higher, I would love a right or right out short on the backside of the old up channel that coincided with the bigger 1.618 around 230.59. That could be like the big blow off, and that may coincide with like a Fed rate hike or something. But these are my upside targets as of now: the 221.09 and potentially the 230.59 if we don't wind up getting kind of the breakdown. Listen, I don't know what the order of operations is going to be, if we get the move up first and then the collapse, or if we get the pullback into this area first and then rally into the end of the year. So how do we know which way to play it? Quite simple. Actually, it would help. Let me get back into more current times. If we get above 219.60 and it holds, then I think we get the move to the upside. If we lose these kind of look below and fails, and this was the Fed minute day, anything below, in my view, the low of day of this day, which was 216 quarter, and the low here was 216.03. So anything below 216s, and my guess is the 50% fib will coincide with that if and when it happens. So if you lose those lows and the 50 when it comes there, then I think we're short. If we take out the 219s, then I think the play is to the upside. So we'll keep it that simple, stupid. We could even add to the position, put on the monthly. We have a monthly bar here. I'm sorry that this is, we're into the second month. So anything, again, the high there is the 219.60, so anything above there is long, but anything below the monthly low here, which was 214.25, would be a place to kind of add to the short, in my view. So that's my take. Anything above these two highs is a long. Below that low would be the add to the short, because we'd already be in it at below the 216s. So that's my take on the SPY. IWM showing a little bit more relative strength here. 52-week high. This is sort of the risk-on assets, right? Take a look. The 20 MA here is now supported here twice, here, 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 the look below and fail. I'm thinking this could rally to the higher end, but the 20 MA is the key. Any closes below the 20 get squishy and could be right or right out short action. Yeah, so I like IWM long against the 10 and the 20 MA here. Below there, it's on either a GTFO or a right or right out short. The Qs. This isn't doing much. A little weakness in Apple lately, I think, although I'm going to talk about that. That could be turning around. Has been kind of holding this down or back. But as long as we're above 115.75, the play is long. Below these double bottoms, these kind of tweezers, this was 115.95 and this was 115.91. Anything below these two lows is a right or right out short for a play at least to the 50 in my view. Anything above here still remains a long though, and I don't want to mince words about that. Apple. So we got the gap fill. Minor pullback here. We held really right where we needed to, although these are poor lows. I was actually hoping for a move down to the channel low, which would have coincided with the 103.74 and gotten out a lot of the chase. But we broke trend here and had follow through. We're kind of at a decision point. Look at these hammer lows. These were at 108.34. The high of day here was 108. So I'll keep it simple. Above 108 remains a long, probably for a retest here of the 110s. Below the low, which is 106.82, this to me would be kind of a look up and fail, and we would probably come back down and retest the lows. So below 106.82 is a right or right out short, and then if you can breach below here the 105.5, it's an add point. So below the low of day on Friday is a right or right out short, and then below 105.5 is an add for a play down to the trend channel low. But above 108 to me remains long for a retest of 110 and maybe even 111. Yeah, so that's Apple. Microsoft is just hanging out. Anything above 56.85 remains, I believe, a long. This is just chopping, but below here could be a quick right or right out short to 55s, but this is just kind of marking time above this high. The .com bubble kind of high was 59.97. I think we're going there. I drew in a 1.618 to 62, so I think we would get here and between the 59s and 62s. To me, seems like it's in the cards for Microsoft. Facebook starting to right the ship a little bit. We're still in one of these kind of consolidation modes. I've drawn these in before. All right, we don't have it here, but this is good enough. Consolidation, more consolidation. Let's keep it real simple. Keep it simple, stupid. You have 1, 2, 3, 4, 5 days here, or really 1, 2, 3, 4 days of consolidation after this kind of big up bar that took you over the range here. This was the swing low, 125.10. So anything above this range high here, 126.73, kind of remains a long for a retest of the high. I don't think that the highs this stock made in after hours in 131s and 132s, which were up in this kind of area, are good. I think we're going to revisit the one, at the very least, the 130.43 at some point. But if we were to lose this 125s, then I think we're coming back down to the 122s and maybe even the 120s, which is now where the 50 MA would be. So it would be below here, I think could be a 50 MA play, but above the 126.73, it still seems like it's going to go higher. Facebook is the best of breed. It's potentially one of the greatest companies of all time. And I don't think the highs are in for that, but it could be it could be an order of operations situation there. Amazon broke the channel, but more by time than by price. As you can see, Friday was a new 52-week high. It didn't close particularly on the highs, but this has just been chop. I think it's really just marking some time. I've been hoping for a really large pullback in Amazon to buy for the fourth quarter, but Seems to me like 833.91 at some point. Maybe that coincides with the backside of the old uptrend line. Is in the cards at some point. That's the big 1.618 Fibonacci extension too. So I think that that's in the cards. I just don't know, like I said, the order of operations. As of now, the last time the 50 MA held, so I would say any dips to the 50 MA are right or right out buys, but Amazon still seems like it's going to kind of grind to the upside. Netflix starting to look a little bit better. In a bit of a new uptrend here from the gap. As long as this holds the 10-day and the 20, I think it's okay. We got the gap fill. The back off has been rather minor. I do think that the 200 MA, which was sort of where we broke down from here, you could see once this broke here, it was kind of fugly. It was some resistance. We couldn't hold above it. So this really needs to clear the 200 MA, in my view, for liftoff to get up to, maybe these 108s. I do think that that is in the cards at some point, but we first need to get above and clear the 200 MA. Once that can happen, the stock can more sustainably rally. Below there, it's kind of just going to be I guess I would say a hold. Any pullbacks to 92s, 93s, I think is okay, as long as that holds to kind of BTD, but really needs to clear the 200 for more. Google rallied, got to the old all-time high. Again, what did we talk about coming up from the bottom? Having a bit of a minor pullback, and now on Friday closed above the downtrend. So I like Google long over Friday's high of day of 797.10 for right or right out long for a playback up to the high in the 813. Any move below 793.26 is obviously a stop out. It's the 10-day MA and would be a false breakout and could also be a right or right out short. So Friday's range, it's a narrow range, which is great for Google, so you don't have to risk that many points. Above 797.10 long, below 793.26 is either a stop out or a right or right out short or a GTFO if you're already in the position. Tesla, this is a huge disappointment. Once it lost the 200 MA, it was trouble. That was where it supported in after-hours earnings. I don't know that the move down is going to be that dramatically much more, though. I do think that this, 187 to, let's say, 191, 195 region, somewhere in here, I think. It's also the backside of an older downtrend. This is sort of a regression area, a range distribution. I think that this would hold short term for maybe a bounce back up to retest the 200 MA, but I think that bounces to the 200 MA are shortable. I think the reason is the bears are hanging in because they know that there has to be an equity issuance for the Solar City deal, and there's no reason for them to kind of back down at this point. You need to get back up above the downtrend, in my view, to kind of right the ship. The big breakdown bar high of day there was 211.11. So anything below there to me still remains vulnerable. If this bounces back up, like I said, a 200 MA is a good right or right out short. If it can clear the 200 MA, then it's repairing. It's repairing. That we'll keep it that simple. Price line. This is holding up high and tight. I mean, this to me just looks like it's marking time. If you want to be long, the 20 MA here is okay. Anything below there would be a stop out. This filled a gap to exactly to the tick, and the back off has been rather mild. So I think anything back through 1449.90 would be a play to the channel high, wherever that is, maybe as high as even 1600. But if you lose this range here, this 1392.44, maybe you would get a gap fill first back down to the 359.99, which would probably coincide with a 50 MA. So 20 MA plus, I like it being long. Below there, maybe not as much. Expedia is also kind of forming a pennant. Lower highs and some lower lows, so you have to be a little careful. But I will say this, if you're aggressive, and I'm not saying that you should be, but I'm just saying if you are aggressive, the 100 MA here, look where this kind of broke down from. It was resistance here, supported here. Once we broke below again, it got weak, couldn't sustain above, resistance again. Now we got back below, above, a retest here. To make a long story short, if you're aggressive, you can be long against the 100 MA and use the 100 MA below as a right or right out short or a stop out. So 100 MA is the must hold here. That's my view on Expedia. Kind of the poor man's price line, but I think Expedia is a really well-run company. Chipotle is a similar 100 MA story. Was resistance here, resistance here, resistance here, resistance here. Now we're at a pullback to the 50. If you want to use the 50 MA as a right or right out long, that's fine. And then an add over the 100 MA. But as long as we're below the 100 MA, the stock is vulnerable. So the 50 and like this 20 MA confluence here is the must hold. These lows are super poor. I think this just came down so much that it wound up bouncing. I think another play down here would not end as well, and that would maybe take you down to finally to 312. But I like this as a right or right out long against either the 50 or the 20, and then an add above the 100 MA. Or if you're more conservative, like I really am, you'd be looking for a close over the 100 MA and then play it long. So Chipotle, under 100 MA, still remains a little bit vulnerable. TWLO, trend break here a little bit. If you want to play TWLO long, the 10-day, look at this, was resistance multiple times. I like long again, and you could see it was support, then a little resistance. It should support again. I like TWLO, I guess, long versus the Friday low. So if you lose 54.93, it's a GTFO, because that would also be a break of the 100 MA. But as long as it's above there, the stock can rally again. The ACIA, I said that I thought that this was sort of the end of the easy money, but I thought this would kind of hang high and tight. I had a lot of people trolling me, oh, it's breaking down, but look, it's right back up in your face. I've seen this. I've been to this rodeo. This is not my first time to the rodeo. These stocks don't just collapse right away. They mark time, and they chop, and they frustrate people. If you want to be long against the 10-day MA, these days here, you have 4 days of consolidation. So I guess 110.5 if you want to be long. The low here was also 110.5. So I like ACIA long against 110.5. Below there, I like it as a short. We'll keep it that simple. I'm going to end on AMBA. I said to take profits into this because this had run. They reported a good number. The stock initially rallied in after hours. It didn't rally enough. I said that, and I said if it can't rally, it's going to go lower. And it did. We are holding the channel low. Let's keep it simple. Ambarella below 65.04 is a right or right out short for a play at least to the 50 MA and potentially some of these Fibonacci levels. If you get back up above the high, which was 70.30, then it is a long. So I either like it above the high of day long, which was 70.30, or short below the low of day for right or right out, which is 65.04. That's my story. I'm sticking to it. I hope you all had a great holiday weekend. The end of the summer is upon us, unfortunately, and it's going to start getting cold soon. If you're not following me, follow me on Twitter. My handle is @JustinPulitzer. If you're not subscribed to my YouTube channel, I don't know what you're doing. Hit the subscribe button. Give me a thumbs up. Leave me some comments. Show some love. All right, that's it. I'm going to aim to do some Periscope probably because it's a short week, maybe on Thursday. Maybe Wednesday or Thursday, but more likely, well, we'll see. Anyway, I'll post it on the stream. So that's it. Have a great rest of your weekend, the last few hours, and cheers.